Welcome back. Markets are constantly evolving, shaped by macroeconomic forces, policy changes, sectoral shifts, and technological disruptions. Identifying these shifts early and positioning portfolios accordingly can be the key to outperformance. However, this requires a deep understanding of market cycles, valuation dynamics, and business fundamentals. Now, let us welcome our esteemed speakers, each of whom brings a wealth of experience in market analysis, investment strategy, and portfolio management. We have with us Mr. Prabhakar Kudva, director at Samvitti Capital, and he has been passionately involved in the markets for over 2 decades. As one of the co-founders of Samvitti, his investment philosophy revolves around identifying high-growth businesses with the potential for significant scale-up. He's recognized as one of the 40 under 40 investment managers by AIWMI. Mr. Prabhakar combines his background in computer science and business management with deep market expertise. His consistent track record of outperforming indices over long periods makes him one of the top performing portfolio managers in the country. We have with us Mr. Sanjaya Satapathy, portfolio manager at Ampersand Capital, coming with over 16 years of experience in fundamental research across multiple sectors, voted as the best mid-cap analyst by Institutional Investor and the best stock picker by Starmine. Mr. Sanjay's expertise in equity research is widely acclaimed and recognized. He spent a decade as a senior analyst at Bank of America Merrill Lynch and began his career at First Global before moving to HSBC and ABN AMRO. And holding a Bachelor of Engineering in Electrical from UC Burla and an MBA from XIM Bhubaneswar, Mr. Sanjay's research-driven approach plays a crucial role in Ampersand Capital's investment strategies. We also have with us Mr. Arun Chulani, co-founder of First Water Capital. He's a seasoned investment professional with over 20 years of experience. At First Water, Mr. Arun oversees business development and operations, ensuring the firm runs efficiently while navigating complex market cycles. Prior to this, Mr. Arun led the principal investments team at Icarus Petroleum Industries, managing over $500 million in AUM with a focus on the energy value chain. Mr. Arun's earlier career at EY London and Dubai saw him build the debt and capital markets division across the Middle East, where he structured transactions for sovereign wealth funds, FTSE 100 companies, as well as major financial institutions. A chartered accountant with an MSc in accounting and finance from LSE, Mr. Arun's expertise spans manufacturing, shipping, chemicals, and capital markets. This session is going to be moderated by Mrs. Ritika Farma, who is the Director, EVP, and part of core founding team at PMS AIF World. Ms. Ritika is a highly progressive and performance-oriented individual and carries more than a decade of experience in investment advisory and private wealth management. Ms. Ritika believes that the best returns are not made by making best purchases, rather by making informed investment decisions. On the educational front, Ms. Ritika is a commerce graduate from Delhi University, holds financial planning and wealth management degree from the Indian Institute of Financial Planning and Wealth Management, as well as many other investments-related certifications as stipulated by regulations from time to time. Ms. Ritika, it is now over to you to steer this session forward.
Thank you. Thank you so much, Aishwarya, for the kind words and the warm introduction. Good afternoon to the fund managers out here. I think what better time than the current one to discuss about the equity markets. Everyone is wanting to understand what next. Over the last few months, particularly the last 1 month, was very, very troublesome for the equity markets, wherein we saw a lot of sectors, a lot of stocks seeing massive correction and eroding a lot of capital or wealth for the investors. Interestingly, I was reading one very interesting data point yesterday, which says that the earnings growth of Nifty 50 is right now higher than the price of Nifty 50. So this clearly means, and this clearly indicates that from the valuation perspective, the valuations in large caps look very interesting and very exciting at this point in time. So with that, I open this session by asking my first question to you, Sanjaya. Are we right in saying that from the valuation standpoint, large caps look very interesting, very exciting? Is this the time to really shift the gears and increase our allocation towards large caps? And if yes, then which are those sectors, which are those sectors which you feel should be added or interestingly looked at this point in time?
Yeah, hi, Ritika. Thanks a lot, and thanks a lot for to PMS World and yourself for a great introduction. And you guys are doing a great job conducting this event just at a time when market has taken a big beating, and we need a bit of a handholding to look forward. I understand your question about whether one should be shifting towards large cap, uh, and I got your point about earnings growth. So I'll just highlight two, three data point. Yes, the earnings growth of mid cap and small caps were in excess of 20-25% in previous 2-3 years, whereas Nifty was growing at about 10-12%. And Nifty growth has come off, and so also small cap, mid cap, and now there is not much of a difference in growth rate of both these sectors today. And considering that the small and mid caps were more expensive, so relatively speaking large caps are looking better. There is no doubt about that. And whether they are looking exciting, that is a secondary question. The one particular data that I would like to throw at you is that since 2007, that is that global financial crisis, there have been six instances of 20% decline in mid cap indices. Okay, there are six instances. Of course, 20% and more. So the data that I will give you is that after that 20% fall happens, if one investor gets in, then what happens in the subsequent 1 year? So out of the six instances, in three instances, mid cap was flat to slightly down after 1 year,
Okay.
whereas Nifty was positive in all the 6 years. But having said that, in three of those six instances, once the recovery started, mid caps did far better than Nifty. Okay, the first thing first is that in general, the risk reward wise, you will not lose money in over next 1 year after this kind of a fall in Nifty, that is large caps. But if it is not a prolonged bear market driven by some kind of a financial crisis, like the way it happened in subprime crisis time, or the way it happened in taper tantrum time, or let's say those time when bank failure happened, then if the recovery happens, both do well, but mid cap probably will do better. But if considering the lack of risk appetite, I will agree with you is that on a safer side, a large cap looks,
More safe.
yeah.
Sure. So which sectors, you think that are looking very interesting, very attractive,
Yeah.
especially from yeah.
Yeah. So if you see this next round of recovery in market will be driven by interest rate cut
Okay.
and by increase in liquidity and support by, let's say, tax cut as well as monetary policy support. So to that extent, the first set of beneficiary will be those large private bank or large NBFCs. Okay, that those things which will definitely looks good both from valuation point of view as well as from the safety point of view and the growth coming back to them. Beyond that, if you look at it, while the tax support and rate cycle are going to spur consumption, but whether it will support rate sensitives like automotive or real estate or consumer discretionary more than staples, that's what we have to consider. To my mind, it is the growth will be bigger in the consumer discretionary and rate sensitive sectors than staples. And while the valuation point perspective, one has to dig deeper and figure out what is something which is right for you. But on a big picture basis, it is the consumption where the recovery has to happen, and as that is the typical business cycle, and these are the things which we should do well.
Sure, sure. Thanks. Thanks. Moving on, since we discussed large caps, I would now like to touch mid and small caps. From the index level, if I have to study the data, mid caps have corrected by broadly 19-20%. Small caps have corrected by 21-22%. Prabhakar, you are somebody who is, your portfolios are more dominated towards mid and small cap. So I want to understand from your side, um, while there has been a correction, but from the valuation standpoint, they are still kind of trading at premium, right? So what do you have to say about this? And do you fear that there is more correction expected on this side of the market? And if yes, then which are those sectors that can see even more beating from the current levels?
Yeah, thanks, Ritika. See, I think the question at the top of most people's mind is, the one that you put, right? So how much more to go, right?
Correct.
So, and I think all of us on the panel, I mean, having seen multiple cycles, I think all of us will agree that, see, this last phase of selling, right? Whenever there are extremes on the price action, it is very difficult to pinpoint where it will end, because what typically happens is, just to understand the dynamics, right? So what typically happens is the sellers in this phase are more indiscriminate, right?
Hmm.
It is induced more by emotions than by logic.
True.
And the buyers, like the people who are fortunate enough to be sitting on cash, like if we have cash right now, what do? We wait and watch, right? Or we deploy very, very slowly, very, very incrementally. So what this phase of the market does is it creates a very major demand supply dislocation, right? Albeit temporarily, right? So temporarily, this is a phase where a lot of mistakes happen, right? So this is not a phase to do anything adventurous, right? To sell out in panic. And anybody, my advice would be to not, if you can't invest, at least don't reduce your exposure to the market, right? You may
Hmm.
keep doing these shifts and all that, but because this is a very dangerous space for retail investors, because this is a dislocated environment. And as soon as the selling exhausts, right, the buyers will step in and we will see a fairly decent rebound. Maybe we will pull back 33% or 50% of the fall that we have seen, right? So we've fallen, let's say 20%, we may pull back 5 or 10% back, right? So that is the time when somebody has to take stock, right? Having said that, post that, I think we have to also see this correction in a slightly longer perspective, right? So
Okay.
what has happened in the mid and small cap space over the last 3 years? We're all focused very much on this last 1 month, right? But as
Right.
long-term investors that we are, we have to step back and think about what has happened in the last 3 years, right? Mid and small caps have gone up. I think even after this correction, they're up about 70-80% over the last 3 years, right? So this correction, we've had very good, last 2 years. So after this correction, after this, brilliant performance, right? This 2025 was always going to be a subdued year. That is what the data also says.
Hmm.
A series of good years is always followed by a subdued or a bad year, right? That is the nature of the markets. Now, this was known, but the extent of the correction is never known. Like Sanjay said, there are many. He pointed out many instances of 20% falls, right?
Correct.
Whether it is 20 or 25 or 30 or or 15, that nobody knows, and that's very contextual. But the fact that this was going to be a difficult year was very well known, right?
Hmm. Hmm.
So that is one point. Now, having said that, is there a way to avoid it, avoid the drawdowns, avoid the corrections? I don't think so, right? We as investors have to be very clear about the product in which we are investing at the outset, right? So the whole game of markets is about risk and reward, right? If you're investing in large cap, what happens? You are signing up for moderate returns and moderate drawdowns. If you are
Correct.
signing up for a small cap, you're playing for bigger returns. So the cost of that bigger returns is the higher drawdowns. There is no running away from it.
True.
Nobody can, I mean, people can say whatever they want, but there's no running away from it, right? So it's the pain and pleasure is always, it's like the yin and yang, right? So it's always, you can't say that I want the best of the small caps, but I don't want the drawdowns, right? So the
Hmm.
product selection is very important. And once you have selected the product, you have to take the good and bad of it, right? And take it with both hands, right? And look at your returns across the cycle. A lot of people are saying, "Arey, 1 month I have fallen so much," but no, you're not supposed to see it. As long-term investors, you have to see what has the product done over 2-3 years, right? And over 2-3 years, 20% CAGR is very good, right? And that is what the focus. The focus has to be there. And one final point I'll make about small caps, right? So people think, 5 to 10 years back, see the word small cap, it evokes a very risky reaction in people's mind that, hey, small caps is risky, small companies, they may just go bust. But there's a fundamental shift that has happened in our market, right? The way Amphi has categorized small cap, the smallest cap, the definition of small cap is starting from 35,000 crores market cap, 30 or 35,000 crores, right? That's about $3 or $4 billion, right? So the small, what is categorized as small cap by our mutual funds, they are not small caps. That's point number one, right? So if you look at the average market cap of the small cap mutual funds, right, they are $1 billion market cap companies. They are not the small caps of 10 years back, right? Where they were, and the promoters were not known, nothing was known. These are fairly scaled up companies. Just that because of the AMFI categorization, they are being called small caps. So if you look at the underlying business, right? If you look at the underlying managements, there is a lot more maturity now than what was 5 years and 10 years ago. So small, and the mid cap starts from 80,000 crores, which was probably a large cap, 5 6 years
Correct.
back.
Correct.
So I think to conclude, right? One, the correction, is likely to, once this dislocation gets over, you will see a bounce back. Number two, it's important to step back and take a look at the medium to long term return and understand which product are you invested in and take the good and bad of it. And number three, understand that small and mid caps are not so adventurous and bad of what they were 5 10 years back. The country has moved on, the economy has expanded, the size of an average small cap today is much bigger. It's a much more mature business and with much more mature management. So I would say there's nothing to panic. We've seen many corrections, right? This is not the first correction we are seeing. And one thing which has always been true across all corrections without fail has been that if I think Sanjay pointed out, right? If you know, every correction looks like an opportunity 1 year down the line, 2 years down the line, right? So why should this one be any different? I think we'll sail through.
Correct. Thanks for that answer. Arun, what are your views? You're also somebody who is predominantly a mid and small cap player. So what do you think about this part of the market?
Yeah, I mean, look, India's a tale of two cities, essentially. I mean, if you look at the headlines at the Nifty, then I mean, I don't know after yesterday, but they've just been well priced, fully priced. But really, there are over 5,000 stocks that are listed. We have an investable universe of over 1,500. And you only need a handful of gems to create alpha. And just because India was, at least in a bull market, it doesn't mean every company, every sector has been in a bull market. And that's really our job, just to find that handful of gems that are well valued. So, we are constantly repositioning ourselves. Just because a stock is moving up, we're not waiting to sell at the top. We have risk mitigation on the way up, where we're selling down, finding the laggards, finding those stocks that are still undergoing their bear markets, or whether they're in infrastructure, which is doing very well. You still can find a handful of names that really haven't benefited, or whether they're in sectors such as textiles, chemicals, flexible packaging, which are just undergoing their own bear market. So effectively, that's really our job, to find the new wave, and that's how we play it.
Sure. So with that, I'll have a follow-up question, for you, Arun. You spoke about some sectors. So which sectors you feel are, you feel that will be a part of the upcoming bull run, which are definitely looking very interesting at this point in time, and you would like to add those sectors in your portfolio in the times to come. So I want you to highlight this as well, and why.
Sure. Got it. I mean, for us, again, that's our job, to be active, to reconstruct the portfolio even in bull markets. So we're already positioned. It's not that we were waiting for a correction. We know that it will come. We just don't know when. And we're already positioned in that place. So we may have some that are in let's say, the sectors that have been benefiting, but where have we been, let's say, redeploying our cash is into what I've just mentioned. So it could be chemicals, and it's not across the board. We're not taking, the whole chemical sector. We're analyzing each and individual one that we come across that's well valued. But we're not just there looking for value traps. We're saying, what's the unlock? What's the catalyst that's going to unlock this company? Or we're looking at the business cycle. We're looking at the realizations, the margins. When are they improving? When are the green shoots happening? So it's not that block. It's not absolute terms where we sell out and buy into these laggards. Because if you do that too extremely, you're going to be just sitting underperforming the market. But if you don't do it enough, then when the correction comes, usually it's those stocks that have risen the most that are going to get impacted the most. So it's a very delicate, moderate balance where you reconstruct from the good times to the ones that are laggards. And so, yeah, to answer and summarize this question, we're very much positioned in a handful of stocks across these sectors, whether it's the chemical sectors, whether it's the flexible packaging, whether it's infra and infra ancillaries. So that's very much where we're repositioning our place. And it may not just happen in the next bull run, but typically when we like a stock, we want a minimum upside of 100, 200, 300%. But time, you have to give, a value guy time, because it doesn't mean just because someone's invested it's going to shoot up immediately. Things take time. This is the real world where capex takes time, or government takes time to sign off on things or acquire land. So effectively, everything is time driven, but you have the asymmetry on your side. You have the asymmetry of risk and reward on your side, hopefully, as long as you got your calculation of the intrinsic versus extrinsic value correctly, and that's what you have to really work for.
Sure. So, what are the key things that you look for, when you're studying a particular sector? So, what are the key things that you largely study that makes you feel comfortable to add that sector to your portfolio? I'm talking about from the current perspective. What are the key things that you look out for before adding any sector to your portfolio?
Well, at heart, we're value guys. So the key thing has to be value. You don't want to be entering at, because that gives you comfort, even in times like this, where there's volatility, there's violence, but you can sleep at night. Because effectively, as long as you've picked the right stock, picked the right story, then you're already, let's say your intrinsic value is already higher than the current market value. So even if the market value falls, that's in fact giving you a better discount to enter. Or even if it falls and essentially you can still sleep well because you're just again waiting for the time. And other than that, you're looking for the catalyst. What's going to unlock that value? Because there are a lot of value traps out there. Companies may have a lot of land that they bought a long time ago, but if they're not going to sell it and give it back to the minority or use it, then it's always just going to be structurally undervalued. So you're looking for the catalyst out there. What's going to unlock it? So that could be overlooked structural growth. That could be the turning of a business cycle or a change in government initiatives. For instance, where are they spending the money? Or are they increasing their budget in a certain sector? So, or what's happening in China? Of course, I mentioned a lot of commodity plays. So China is very much the big daddy in the room. What are they doing? Are they reducing capacity? Are they increasing? What's happening there? So that's an exogenous factor that is going to impact your sector. And of course, you look at the upside. What is the upside? And here you're going to concentrate your portfolio accordingly. If you have let's say a mutual fund thought process where you have 50, 60 stocks, even if the stock doubles or triples, what's the real impact on your overall performance? There's not going to be much. So if you really like a story, really like an upside and you have strong conviction, you want to concentrate it, you want to take a big swing at it. You don't want to just take a quick single, you want to go for a 6 at least. So again, concentration is very important. So those are the various factors you really have to look at, as well as the overarching macro.
Sure. Thanks. What about you, Prabhakar? I have kind of studied your portfolio and I saw that you have, added some multi-bagger stocks to your portfolio in the last few years, and that has definitely resulted to very good returns in your strategy. So, what are the key things that what are the key things that you look when you are creating a portfolio? For example, today, if you have to create a completely fresh or a new portfolio for any client who's coming to you, which sectors will you add, keeping in mind the current market scenarios that we are into, number one? And secondly, what are the key things that you will identify or you will study to add those sectors to your portfolio? So I want you to kind of broadly touch on this entire aspect for us.
Sure. So we do a things, slightly different from I think what the industry does, right? So, and even earlier we used to have this circle of competence approach, right, whereby you understand the business, and then whenever that business comes in your valuation band, you go ahead and allocate to it in a big way. Much like what Arun mentioned, right?
Correct.
So that works quite well. That works quite well. And like Arun currently, correctly mentioned, right? So the issue with that strategy is that, it takes time. Like he said, time is
To value unlock.
is of essence there, right?
Hmm.
So a lot of times, there may be, a couple of years where, you have to end up underperforming. And, when you're managing public money, so there are a lot of pressures on us in terms of continuous outperformance. So a certain kind of capital can definitely do the circle of competence approach which Buffett, Munger, and Arun spoke about, right? So we did this analysis, and we looked at the biggest winners in any given year, and we did this across many years, and we found out that if you look at the biggest winners in any given year, right, they are always new stocks, right? They are not stocks where you can have a pre-decided circle of competence available to you, right? So we kind of pivoted, completely to a completely data-driven approach, because earlier what used to happen is, if I know about that company only, then it will go into my portfolio, and if my company is not aligned with the what the market is aligned with, then I end up underperforming, right? So we went to a completely data-driven approach, which is driven primarily by earnings, right? And we look at an earnings delta. So we allow the market to tell us, so we track about 1,500 companies, and we look at, each of these companies' earnings every quarter. So we allow the market to tell us where the earnings tailwinds are, where the delta is coming, and and build, identify a bunch of those and build a portfolio around that. And more importantly, typically, investors take a 3 to 5 year view, right? Because you've studied a business, you've taken a call, you want to wait for 3 to 5 years, but we take probably a 2 to 8 quarter kind of a view. That doesn't mean that we are focused on 2 to 8 quarters. So some of the companies which we own, right, we've been owning them for multiple years, but we run it in sprints of 2 to 8 quarters, right? So the analysis, because I can't call out what will happen 3 to 5 years down the line, right? It's very hard to do that, especially now. So these are the two, building blocks. One is focus on where is the earnings delta, because the biggest winners in any given year are not the cheapest stocks or the stocks which are already growing fast. It is the stocks which are growing slow which suddenly start growing fast, because then you get the earnings growth and the re-rating both. So that is the ideal scenario. But you don't always get that, but we are looking for that delta. We are looking for that. So that is one of the core aspects, and we are re-evaluating this on a quarterly basis, right? So if the company does what it is expected to do, doesn't disappoint a lot, we continue to own it. Right. So some companies end up staying in my portfolio for just 2 quarters. Some companies end up, staying in my portfolios for a few years. Right. So that is broadly the process that we follow. But to answer your question about the sectors, see, again, so the trifecta of stock selection is typically is growth, valuation, and a theme, right? It is these three. When you put them together, you get a winning stock,
Hmm.
right? So in the current environment, I feel that when I look at the earnings of Q3, I look at the delta growth, both in Q3, expected in Q4 and FY26 is primarily in the mid cap pharma space, right? So that is where the growth is seen. That is what the managements are talking about. So you get growth, but obviously you don't get the best of valuations right there, right? So that is one sector where the growth is picking, but the valuations are reasonable. Post this correction, nothing is very frothy. Things are reasonably valued. There are pockets of opportunities there. So that is an area where there is growth. Growth is full marks, but valuations maybe half. You look at financials, right? You are not very sure of the growth, but the valuations are quite good, right? So large cap and mid cap financials as a space looks quite good to me. But growth is uncertain whether it will come, how durable, question marks. But there is an opportunity there, and a sector where both growth and valuations look fairly okay, I feel, is textiles, right? So
Okay.
textiles is an area, especially the garment players, the larger players, where there's not much froth in terms of and in terms of valuations. The growth has been reasonably good, and I think both mid-cap pharma and textiles are a very good play on global growth, right? So if the last 2 3 years have been about India, right? So you can play the India thing by financials. And if you want to play the return of the global growth, whether it is in Europe or the US or the larger part of the globe, then I think pharma and textiles, seem to be good bets. The black swan obviously is the tariffs, right? So if something, so that can be a short-term headwind for both of these sectors. Hopefully, it's going to be more of noise and less of, because they are very well entrenched in those markets, right? It's not, you can't just overnight throw out pharma or textiles from the US, economy, right? They're quite well entrenched there. So I would say these three sectors where, there is some interest.
Sure, sure, sure. Got it. So moving on, Sanjaya, my next question is to you. The last rally was largely dominated by infrastructure and related sectors who kind of contributed significant to the last bull run. And now we've seen government definitely announcing tax benefit to boost the consumption in the country. So you feel that this is the right time to maybe look at consumption theme sectors in your portfolio, and apart from consumption, which are the other sectors you think that if you've been given an opportunity to create a new portfolio now, which other sectors will you add?
Yes, you are right in a way to kind of support your argument that the last couple of years were infrastructure driven. Yes, for next year at least, the government allocation for road and railway is not growing. Uh, so, uh, and of course, the consumption is getting a boost. But the one thing that we also should also kind of conclude here is that that government boost came at a time when rest of the economy was not doing well, so
Hmm.
they took a counter cyclical measure, so to say, to kind of pump prime the economy after the 2022 uh, shocker happened in terms of war, and external environment was fairly weak, and within India also the inflation was high, but the private sector investment sentiment was not still good enough. So now that the consumption has slowed down quite some time now, and the government cannot really do more compared to what it is already doing on the infrastructure side, and the amount of road which the government is kind of stretched that way. So that is the reason why probably these steps are being taken to promote consumption. uh, but you also should also accept that apart from consumption, it will be the private sector capex also, that is something which will do well, because like the with the demand outlook improving, the private sector also should feel encouraged to invest and expand their capacity. So we are not really trying to take a generic conclusion about consumption versus capex. But having said that, I will just I'll just lay out like what are the sectors where the growth will be disproportionate, and that will decide our approach to investing. And the growth will be driven by two things: one is the margin, and the other one is overall demand for that. So there are a couple of sectors which we feel that there will be margin support. Let us say, for example, I feel that after such a huge investment on, let's say, renewable energy like solar, etc., the cost of power is something, at least over next 1 or 2 year, will decline. So some of the big users of electricity can see a decline in their electricity consumption cost. I'll just give you a very random example. Like there is this company called Amar Raja Battery.
Hmm.
Okay, their electricity cost increased substantially this year. That led to margin decline. But that company, and that company doesn't really buy through some direct purchase, but through state electricity boards. And the state is now going to buy more of renewable power, which are at a much lower price, and which is why they have given a guidance that next year their energy cost may go down by some 15-20%. Okay, so that is a big thing. So a lot of those users of energy will see margin support. The second thing that we must also see is here is that let's say because of war in Middle East, the logistics cost had gone up a lot.
Hmm. Okay.
Okay, now with even though the war has not really completely stopped, so to say, but because of all the announcements which have happened over last couple of weeks, the international container freight index is down has fallen by 20-30%, and it is overall on a year basis it is down a lot. So like say for example, we are constantly focused on this Trump tariff, but we are not really talking about the peace that has returned to so many conflicted zones, and that peace dividend is something which we are not talking about. But a lot of these companies, for example, there are some of these pharma exporter or even importers. Let's say, for example, Divis Lab. They said that their margin today is far lower than pre-COVID time because of logistics cost.
Okay.
Okay, and if logistics cost is to go back, if energy cost is to go back to much lower level, then there will be huge beneficiary. That is something which we should not really ignore. As far as the consumption is concerned, we typically jump to discuss, let's say, staples companies like, let's say, ITC or a lever. But what I feel is that there the growth rate will continue to be very muted. Uh, per host of reasons, be it level of penetration or the lifestyle changes. It is very well known that, I mean, it is fairly kind of agree that people are shifting towards more like travel tourism. The consumption lifestyle changes are happening. The retail sector is that is where the bigger growth will be. But most of those sectors are, relatively speaking, are little expensive, and some of those sectors are getting into a bit of a this investment phase. For example, let's say hotels. Probably the hotel rates have gone to a level where they may not really rise much. Hospitals, whether you, I mean, for lack of better word, we can put it in lifestyle side also. There again, a lot of those supply is coming in. So we have to apply our discretion accordingly, like where the margin improvement is possible and where it is not. For example, let us say company like investment which when there is going on in hospitals, in hotels, in commercial real estate because of GCCs coming in a big way. So a company which is providing a genset backup probably will benefit more than those sector. So how we will play that demand is something which will need second layer, third layer kind of thinking than just jumping into conclusion saying that okay, this is something, this is happening because of lifestyle.
Yeah.
And the very last thing that I must highlight is that there are uh, this disruption which is going on between, let's say, quick commerce versus physical retail chain. And but one thing is there, that the consumption is something which is going to recover. How we will play that is something which is the next level question. And like in another panel, the one investor was pointing out that a company like Costco in USA is trading at 58 PE despite growing 6%,
Hmm.
growing at a rate of 6%. And that is that, but Pepsi and Coca-Cola are trading at 20 to 23 times.
Hmm.
Okay, so that means retail is something, even in USA, which is such a matured market, there it is getting better valuation. So similarly, when consumption recovers, we'll have to think accordingly. And typically, a retail player is focused on lease rentals, and when interest rate fall, always kind of supports the valuation of such a sector. So we have to think of that. And
Yeah.
some of the consumer discretion, for example, in last 1-2 year, one of the sector which has done extremely badly are these building materials. Which be it plastic pipes or be it tiles, be it plywood, be it cement, and all of them have done very badly in terms of their revenue, profit, and also stock prices. And with consumption recovering, maybe like real estate investment recovering due to interest rate, maybe that is where things can improve at the margin. So we have to also think about that. And so yes, there are quite a lot where to really get excited about in terms of ideas. So once this kind of a brutal phase of that market correction which is
Right.
going on kind of
Right.
says kind of stabilizes,
Settles.
we
Correct.
will we will bounce back. Yeah.
Correct. No, I think Sanjay, you made very interesting points. I particularly liked one point wherein you've mentioned the impact of green energy on the power sector. So this brings another very interesting question to my mind, which I want Prabhakar you to answer, and then followed by Arun. And probably this, I think, will be the last question of this session. That which are those new age sectors that can really disrupt the traditional industries in the economy and can actually work as a growth catalyst, the way forward. So I want you to kind of quickly spend 2 to 3 minutes each and help us understand more around this. Yeah, so over to you, Prabhakar.
Yeah, I think from an Indian market point of view, see, we don't really have that cutting edge innovation type of things happening here as much as it's you see in the US, right? Whether it is with respect to biotechs, whether it is with respect to any of the new technologies. So I think our market is going to be it will continue to be driven, at least the listed space is going to be driven by, the traditional industries. When I say traditional, I mean a lot of sub pockets coming up now, right? So, so within retailing, like Sanjay was pointing out, I think value retail is something that has emerged as a, big space. And a lot of, other than the large cap, a lot of other smaller companies also in that space are doing very well in the tier 2, tier 3 towns, right? So I think our market is a very broad market, and there are a lot of these pockets and sub sectors, right? Which will which will provide opportunity for growth of the portfolios. Uh, Having said that, I think the biggest threat right now, obviously, is the threat of AI, right? So,
Yes.
as things stand today, that may not look so threatening, but the thing with technology is that it grows in leaps and bounds, right?
Hmm.
So every 3 months, every 6 months. So there was a lot of noise about DeepSeek, right? But
Correct.
DeepSeek is just one. It's not about DeepSeek. It's about the pace of innovation and how things are improving. Every three
Incremental.
months, every 6 months, right? So
Correct.
OpenAI has been releasing new versions every quarter. You have DeepSeek, you have Alibaba doing something. So I think that space can be a big disruptor. That space can be, and that's and I'm talking more from our own IT exports point of view, right? Because services exports or IT exports are our biggest exports. And the narrative, one of the narratives that is going on right now is that the job growth in the in the IT sector, in the Indian IT, may taper off, right? And that has multiple second and third order effects because our consumption, our real estate, everything is driven by the software professionals, so to speak, largely speaking, right?
Correct.
So I think how that pans out is something, and I'm not taking any call right now, because when railroads were invented, if you study history, or when computers were invented, similar, similar thoughts were echoed at that time that it will kill jobs, it will kill employment. But what eventually every technology does is it expands the economy even more, it improves the productivity even more, right? So I'm sure AI also will evolve, in a manner that the entire world will be much better off than worse off, right? Because that's what every technology has done. Right? So I think AI is a space that needs to be watched very closely. There are some beneficiaries here and there, but I think the real game will probably start a few years down the line, right? Because now it's too new. It's like the internet of the 2000s. The real game started in 2010, right? The Nasdaq rally, the big rallies happened post 2010, which is continuing to this day, right? So the app layer, so to speak, of the AI will only come out probably in the next decade, right, or next few years, depending upon the pace of innovation. So I think AI is the space to watch, and we have to look at both the beneficiaries of that, because a lot of productivity improvements will come, and also what can be left by the wayside. So I think that is the space to focus on.
Sure. Thanks for your answer. Arun, what about you? Prabhakar spoke about AI particularly, right? So, which new age sector you think can actually disrupt the traditional, industries out there? So, I want you to quickly highlight maybe one. Yeah.
Cool. I mean, that's a good question to ask someone who doesn't invest in new age. So, yeah, I mean, of course, India's undergone a huge digital infrastructure push. 2015, we were 155 in the world for mobile data access. Today, we're number two for mobile data consumption. So of course, it has to be in the infrastructure for me, in terms of whether it's a fintech, whether it's your health tech, ed tech. All these things are enablers and economic multipliers. For instance, you no longer need to have an ATM branch or a bank branch and a person and a teller sitting in a village. You have the bank branch in the palm of your hand. So all this includes people. It's financial inclusiveness, healthcare inclusiveness, insurance inclusiveness. And in itself, it allows for multiplier effects. But hopefully, I'm not looking at AI and its, let's say, negative effects on employment and whatnot. But I'd rather focus on the inclusiveness of all this, let's say, digital infrastructure and what it can do for the economy in terms of allowing people to benefit by being in the system.
Sure, thanks. Lastly, I just quickly want you to take 30 seconds each and quickly address this part. So, what do you think investors should expect, given the current momentum, the volatility that we have in the market? What should investors expect? I want you to kind of quickly answer this part as well before we end this discussion. Yeah. So, what is that one piece of advice that you wish to give to the investors who are investing in the equity markets? Yeah,
Is that
starting with
me?
you. Yeah. Arun,
Sure.
you can take it. Yeah.
Yeah, average in. I mean, India's got great long-term tailwinds. It's not disappearing because the market is violence. The foreign investors never really came in. I mean, if you look at the numbers, back in 2007 and 8, we were 1.2 trillion in terms of market cap. Today we're around 5, maybe a bit less. But they really haven't increased their allocation. When we're bigger, we're growing as the fastest major economy. And these days will come and go, hopefully. Bull markets will be there, bear markets will be there. And my suggestion, at least to myself, would be to average in, because your first tranche is very much, it gives you the confidence. Let's say the market bounces back, it gives you the confidence to be in the market and continue averaging in. But if the market falls, then very much your subsequent tranches are your weapons against downturn volatility. And hopefully, as mentioned, there are long-term tailwinds that will push earnings, which will push market prices. And effectively, you are averaging your loss as well as your time in the market, which is equally important. So that's what my suggestion would be to myself. And of course, I reserve the right to be wrong. But thank you very much.
Thank you. Prabhakar, how about you? What is that one piece of advice that you want to give to the investors?
Yeah, like I said, it's important, not to focus on what's happened in the last 2-3 months. I think take a step back. Like I said, look at the big picture. The big picture is, very good locally. Everything is lining up, right? The budget has been good. The rate cycle, the rate cut cycle has started. And generally the valuations also have come off, right? So, and globally also the growth is picking up. All the other markets are near the all-time highs. So if you really, forget about what's happening here in the short term, take a step back and look at the big picture. I think this is the time, like I said, to take advantage of yet another correction, right? Like I said, the one thing that has never failed in the Indian markets is that if you put money in a correction, you've never lost money if you stayed put, right? So I don't think this time should be any different. So, but like I said, get your asset right. Be very clear. Commit to an asset for a fair amount of period. Don't try to do jugglery. Midway, right? If you want to put less in small caps, that's fine. If you want to put more in large caps, that's perfectly fine. But stick to it, and I think all of us will definitely make money.
Right, the wave, yeah. Sanjaya, what about you? Is there anything that you want to add?
Yeah, just like I began saying that every time market has fallen 20%, next 3-year annual return, the minimum has been about 15-16% and the maximum has been 25%. So what more do you want? So the market has come off, so we can give any kind of reason, but statistically you are at a suitable time to really invest for next 3 year.
Sure. Thanks a lot for your time today afternoon, Prabhakar, Sanjaya, and Arun. Good day.
Thank you.
Thank you.
Thank you.
Over to you, Ashwarya.